Success is a liar. It whispers in your ear. It shows you green candles. It floods your account with profits. Then it destroys you. Most traders never see it coming. They're winning. They're profitable. They're beating the market more often than they lose. And they're going broke. This is the paradox nobody talks about. The dark mathematics that hides behind every winning streak. The brutal truth that separates amateurs from professionals. You can win 80% of your trades and still end up with nothing. You can be right 4 times out of 5 and watch your account evaporate. You can have the highest win rate in the room and be the poorest person in it. Because winning isn't about being right. It's about surviving being wrong. Today we're going deep into the psychological trap that destroys more traders than any other force in this market. We're talking about the win rate illusion. The seductive lie that keeps retail traders chasing victories while their accounts bleed out. I'm going to show you why your wins don't matter, why what frequency is a distraction, why the traders making real money are often wrong more than they're right. This isn't theory. This isn't motivational nonsense. This is mathematics, psychology, and cold hard reality. Let's begin. Part 1. The win rate seduction. When you started trading, someone probably told you the goal was to be right. Win more than you lose. Get that win rate up. Hit 70, 80, even 90%. It sounds logical. It feels right. If you win most of your trades, you make money. Simple mathematics, right? Wrong. This is the first trap. The initial seduction. The belief that frequency equals profitability. Let me paint you a picture. 2 traders, same starting capital, $10,000 each. They both take 10 trades over the course of a month. Trader A wins 8 out of 10. 80% win rate. Sounds impressive. Sounds like success. Trader B wins only 3 out of 10. 30% win rate. Sounds terrible. Sounds like failure. Now, here's where it gets interesting. Trader A makes $100 on each winning trade. 8 wins times 100 equals $800 in profit. But when Trader A loses, they lose $500. 2 losses times 500 equals $1,000 in losses. Net result? Trader A is down $200, despite winning 80% of the time. Trader B is different. When they win, they make $1,000. 3 wins times 1,000 equals 3,000 in profit. When they lose $100. 7 losses times 100 equals 700 in losses. Net result? Trader B is up $2,300, with only a 30% win rate. Same number of trades, opposite win rates, completely different outcomes. This is the fundamental disconnect. The cognitive gap that retail traders never bridge. They're playing checkers in a chess tournament. They're measuring the wrong variable. Win rate tells you nothing about profitability, nothing about sustainability, nothing about whether you'll survive in this market. It only tells you how often you're right. And being right is the booby prize of trading. Think about casinos for a moment. The house doesn't win every hand. In blackjack, players win nearly 50% of the time. In roulette, you've got almost a 50-50 shot on red or black. But casinos don't go broke. They don't panic. They don't change their strategy. Why? Because they understand something most traders never grasp. They understand expectancy. They understand that math over time is what matters, not individual outcomes. Every game in a casino is designed with a negative expectancy for the player, the house edge. It might only be 1 or 2%, but over thousands of hands, millions of spins, that edge compounds into billions of dollars. Casinos think in probabilities, in expected value, in long-term mathematical certainty. Traders need to think the same way, but they don't. They think in wins and losses, in being right and being wrong, in ego and validation. This is why 80% of retail traders lose money. Not because they can't find winning trades, but because they don't understand the architecture of profitability. They're optimizing for the wrong metric. They're chasing a number that doesn't matter. They're building sandcastles while the tide comes in. Part 2. The psychology of small wins. There's a reason the win rate trap is so powerful. It's not just mathematical ignorance. It's evolutionary biology working against you. Your brain is wired to seek pleasure and avoid pain. Simple survival mechanism. It worked great on the savannah. It's a disaster in the markets. When you take a small profit, your brain releases dopamine. You feel good. You feel smart. You feel validated. This is a reward response that's millions of years old. When you take a loss, especially a big one, your brain floods with cortisol. Stress hormone, fight or flight, your body is telling you that you're in danger. So what do most traders do? They maximize small wins and minimize the psychological pain of sitting through drawdowns. They cut their winners early and let their losers run. They do the exact opposite of what works. And they do it because it feels right. This is called loss aversion. It's been studied extensively in behavioral economics. People feel the pain of a loss roughly twice as intensely as they feel the pleasure of an equivalent gain. You make $100, you feel good. You lose $100, you feel terrible. Not the same intensity, not even close. So, traders unconsciously structure their trading to maximize the frequency of feeling good and minimize the frequency of feeling bad. More wins, smaller wins, quick profits. Bank it while it's green, fewer losses. But when losses happen, they're catastrophic, because you held on hoping it would come back, because you couldn't accept being wrong, because the pain was too intense to crystallize. This creates a specific profile: high win rate, low average wins, low loss rate, high average losses. It's the profile of a slow-motion disaster, a trader who feels successful right up until the moment they blow up. I've seen it hundreds of times. Traders celebrating their win rates, posting screenshots of their winning trades, talking about how they're profitable 8 months out of 12. Then one bad month, one trade that got away from them, one position they refused to close because they just knew it would come back. Account gone. Years of small profits erased in weeks, sometimes days. And the worst part? They don't understand what happened. They think they got unlucky. They think the market changed. They think some external force reached in and destroyed them. They never see the internal architecture, the psychological structure they built trade by trade, win by win, the house of cards they have been living in. Because small wins feel like success. They feel like progress. They feel like you're doing it right. Your brain can't tell the difference between winning profitably and winning unsustainably. The dopamine hits the same. The validation feels identical. This is the trader's curse. The thing that makes this game so brutally difficult. You can feel successful while building the very patterns that will destroy you. You need systems. You need rules. You need mathematics that override your biology. Because left to your own devices, your brain will optimize for feeling good in the short term and destroy you in the long term, every single time. Part 3. The mathematics of expectancy. Let's get precise. Let's talk about the actual numbers that determine whether you survive or die in this market. Expectancy is the single most important metric in trading. It tells you how much you make, on average, per dollar risked. It's the mathematical foundation of everything. The formula is simple: win rate times average win minus loss rate times average loss. If you win 60% of the time with an average win of $300, that's $180. If you lose 40% of the time with an average loss of $200, that's $80. Your expectancy is $100 per trade. Over 100 trades, you'd expect to make $10,000. Not guaranteed, but expected. This is how professional traders think. Not about individual trades, not about win streaks or losing streaks, about the mathematical expected value of their edge over time. Now, let's look at why high win rates are dangerous. Let's break down the actual mathematics. To maintain an 80% win rate and still be profitable, you need your average win to be larger than your average loss. Specifically, your average win needs to be at least 1/4 of your average loss just to break even. If you're losing $500 on your losses, you need to make at least $125 on your wins just to tread water. And that's with no slippage, no commissions, no mistakes. But here's the problem. High win rate strategies usually involve taking quick profits and letting losses run. The very structure that creates the high win rate also creates the unfavorable win-to-loss ratio. Think about it mechanically. To win 80% of the time, you need tight stop losses and wide profit targets. No, wait, that's backwards. You need wide stop losses and tight profit targets. You need to give the trade room to breathe so it doesn't stop you out on noise. But you need to take profits quickly when they appear because the edge is in the short-term momentum. This creates small wins and large losses by design. The mathematics are baked into the strategy structure, and it gets worse when you add in human psychology. Because even if you start with a reasonable risk-reward ratio, you won't maintain it. You'll see a profit and want to lock it in. You'll see a loss and want to give it more room. Trade by trade, you'll unconsciously adjust until you've created the exact profile that leads to ruin. Now contrast this with a low win rate strategy. Let's say you only win 40% of the time. To be profitable, you need your average win to be 1.5 times your average loss. If you lose $100 on average, you need to make $150 on average. That's a 1.5 to 1 reward to risk ratio, completely achievable. But more importantly, the strategy structure supports it. You're taking positions with tight stops and wide targets. You're getting stopped out on noise frequently, but when you're right, you ride it. The mathematics work with you instead of against you. The psychology is still difficult, but at least you're not fighting the fundamental structure. This is why trend followers can be profitable with 30 or 40% win rates. Why breakout traders make money being wrong more than right. Why the best traders in the world often have win rates that would horrify a retail trader. They understand that frequency is negotiable, but expectancy is everything. Part 4. The hidden costs. Now, let's talk about something most traders completely ignore. The hidden costs that amplify the win rate trap. Commissions, spreads, slippage, opportunity cost, psychological capital. Every trade costs you money, every entry, every exit. The broker takes their cut. The market maker takes the spread. Slippage eats a little bit more. When you're taking many small profits, these costs add up fast. You might think you made $100 on a trade, but after commissions and spread, it's $92. Not a huge difference on one trade, but over hundreds of trades, it's thousands of dollars. High-frequency strategies with small profit targets get destroyed by transaction costs. You need bigger moves to overcome the friction. You need fewer trades with larger expected values, but there's a deeper cost, one that doesn't show up in your account statement. Psychological capital. Every trade requires mental energy. Every decision requires focus. Every exit requires discipline. Every entry requires courage. You have a finite amount of this resource. It depletes throughout the day, throughout the week, throughout the month. When you're taking 10 trades a day to maintain your high win rate, you're burning through psychological capital at an unsustainable rate. You're making more decisions, creating more opportunities for mistakes, generating more emotional volatility. And here's what happens. You start to deteriorate. Your discipline slips. You start taking marginal setups. You start forcing trades because you need that dopamine hit. You start revenge trading after losses. The high-frequency approach that gave you the 80% win rate starts to destroy the very discipline that made it work in the first place. I've watched traders go from consistent to completely unhinged in a matter of weeks, not because their strategy stopped working, but because they depleted their psychological capital and started making emotional decisions. Then there's opportunity cost. While you're taking small profits and moving to the next trade, the big moves happen without you. The positions that could have made your month, your quarter, your year, run without you because you banked $50 and moved on. Professional traders talk about home runs, the trades that make multiples of your risk, the positions that define your year. If you're always taking singles, you never hit home runs. And in trading, home runs are where the real money is made. The big trends, the major dislocations, the moves that go further than anyone expected. You can't catch those if you're constantly taking profits. You can't ride a big winner if you're psychologically structured around banking small wins. This is the trap within the trap. The high win rate approach doesn't just create unfavorable mathematics. It creates a psychological and structural framework that prevents you from ever capturing the trades that would actually change your financial life. You're optimizing for feeling good today at the expense of making real money over time. You're choosing validation over wealth, ego over equity. Part 5. The professional mindset. So, what do professional traders do differently? How do they think about this game? They focus on one thing: expected value over time. That's it. Everything else is noise. They don't care about individual trades. They don't care about win streaks or losing streaks. They don't care about being right or wrong. They care about whether their edge is playing out over their sample size. Think like a casino. Run the numbers. Trust the mathematics. Ignore the emotions. This requires a complete mental shift. You have to stop thinking in wins and losses. Start thinking in expected value and variance. Every trade is just one iteration of your edge, one spin of the wheel, one hand of blackjack. It doesn't matter if this specific trade wins or loses. It matters whether the trade had positive expectancy. If you took a trade with a proper setup, proper risk management, and proper execution, that's a successful trade, even if you lost money, because over time, those trades will be profitable. If you took a trade with poor setup, poor risk management, or poor execution, that's a failed trade, even if you made money, because over time, those trades will destroy you. This is the mental discipline that separates professionals from amateurs. The ability to divorce outcome from process. To judge yourself on what you can control, not what you can't. Professional traders lose money all the time. They have losing days, losing weeks, sometimes losing months. But they don't panic. They don't change their strategy. They don't start forcing trades. They check their process. Did I follow my rules? Did I take appropriate risk? Did I manage the position correctly? If yes, they keep going. If no, they correct and keep going. They understand variance. They understand that randomness creates patterns that look meaningful but aren't. Losing streaks happen, winning streaks happen. Neither means anything about your edge. What matters is the underlying mathematical expectancy and whether you're executing it consistently. This mindset is uncomfortable. It requires you to sit through losses knowing you did the right thing. It requires you to accept wins knowing you might have gotten lucky. It requires you to subordinate your ego to the mathematics, but it's the only way to survive long term, the only way to compound capital, the only way to build real wealth in this market. You have to become comfortable with being uncomfortable, comfortable with losing, comfortable with being wrong, comfortable with short-term pain for long-term gain. This is why trading is so difficult. Not because the strategies are complex, not because the markets are impossible, but because the mental game requires you to act against every instinct you have. Your biology wants small wins. Your ego wants to be right. Your emotions want certainty. Trading requires you to ignore all of it and trust the mathematics. Part 6. Building a sustainable edge. So, how do you actually build a trading approach that works? How do you escape the win rate trap and create sustainable profitability? First, you focus on reward-to-risk ratio. Every trade you take should have at least a 1.5 to 1 or 2 to 1 reward-to-risk setup, preferably higher. This means if you're risking $100, you need to be targeting at least $150 or $200. If the setup doesn't offer that, you don't take it. This single rule eliminates most of the garbage trades, most of the impulsive entries, most of the setups that feel good but have no edge. Second, you implement hard stop losses on every trade, non-negotiable. Before you enter, you know exactly where you're wrong and exactly how much you're risking. This removes the emotional decision-making. You don't have to decide if you should cut the loss. The market decides for you. Either it hits your stop or it doesn't. This protects you from catastrophic losses, from the positions that get away from you, from the trades that destroy accounts. Third, you let winners run. This is the hardest part. You have to resist the urge to take profits early. You have to sit through pullbacks. You have to watch unrealized gains evaporate and come back. Use trailing stops. Use profit targets that are actually meaningful. Use technical levels to guide your exits, not your emotions. The goal is to cut your losers quickly and let your winners run far. This creates favorable expectancy mathematics. This is how you make money being wrong half the time or more. Fourth, you trade less, drastically less. You wait for the absolute best setups, the ones where everything aligns, the ones where the reward to risk is exceptional, quality over quantity, every single time. You're not trying to trade every day, you're trying to catch the high probability, high reward setups that make your month. This conserves psychological capital. This reduces transaction costs. This keeps you fresh and focused for the trades that matter. Fifth, you track your statistics religiously. Every trade, win rate, average win, average loss, expectancy, maximum drawdown, consecutive losses. You need to know your numbers. You need to see the patterns. You need to identify when you're deviating from your process. This removes the guesswork. You're not trading on feel. You're trading on data. You know what your edge looks like mathematically, and you know when you're executing it properly. Finally, you accept that this is uncomfortable. You accept that you'll lose frequently. You accept that you'll watch other traders post their winning streaks while you're in a drawdown. You trust your process. You trust your mathematics. You trust that over time, the edge will play out. This is the professional path. It's not exciting. It's not sexy. It doesn't give you constant dopamine hits, but it works. And working is all that matters. The market doesn't care about your win rate. It doesn't care how often you're right. It doesn't care about your feelings, your hopes, your ego. It only cares about one thing: mathematics over time, expected value over sample size, whether you have an edge and whether you execute it consistently. Winning 80% of your trades means nothing if the mathematics don't work. Being right feels good, but it doesn't pay the bills. Validation is nice, but it doesn't compound your capital. The traders who make real money aren't the ones with the highest win rates. They're the ones who understand expectancy, who cut losses fast and let winners run, who think in probabilities instead of certainties. They're comfortable being wrong. They're comfortable being uncomfortable. They have divorced their ego from their outcomes and subordinated everything to the process. This is the mental shift you need to make, from amateur to professional, from emotional to mathematical, from short-term validation to long-term wealth. Stop chasing win rates. Stop optimizing for feeling good. Stop measuring success by how often you're right. Start measuring success by your expectancy, by your risk management, by whether you're executing your edge consistently over time. That's the game. That's always been the game. Everything else is distraction. Everything else is noise. Everything else is the market separating you from your money while making you feel successful. The truth is brutal, but it's also liberating. Once you understand it, once you accept it, you can finally start trading in a way that actually works. You can win 80% and lose everything. Or you can win 30% and build wealth. The choice is yours. The mathematics are clear. The only question is whether you're willing to do what works instead of what feels good. Now you know. What you do with that knowledge is up to you.